If you've had any exposure to the real estate world, you've probably heard the term cap rate. Cap rates can be often misunderstood, so in today's video, I'll simplify what they are and cover 3 reasons having a grasp on cap rates will benefit you as an investor. Before diving into this topic, in case you're not as familiar, I think it's important to establish the fact that multifamily properties or apartments, as opposed to a single-family home, for example, are evaluated and appraised just like a business. You have income and you have expenses, and what's left over is your cash flow or profit. And just like every other business, buyers for that business are going to evaluate what that income is worth based on a variety of factors. And this is where cap rates come in. The technical definition of a cap rate is an unlevered rate of return. Now, I emphasize the word technical because how it's used in the real world is a little different. But sticking with that definition, that means if you were to buy a property using no debt, you pay all cash for it, you could look at your net operating income, which is your income minus your expenses, and divide that NOI by the property's price to give you the unlevered rate of return. So as an example, imagine you purchase a $1 million apartment building. After you collect all of the rent and pay your expenses, you're left over with $60,000 at the end of the year. $60,000 divided by your $1 million price would result in a 6% cap rate, or 6 cap for short. So the formula for a cap rate is net operating income divided by purchase price. This shows that the cap rate is a way to value property based on its income. If you adjust that formula, you can take the net operating income divided by cap rates in your market to arrive at an estimated value. When it comes to actually owning and managing real estate, things are never as easy as just a simple formula though, right? The operating team is going to be paying for things like closing costs and upgrades to the property and other unexpected expenses that come up. As a result, these expenses or upgrades come at a cost and will affect the value of the property itself as well as the return being generated. So the point is, it's too complicated to evaluate a return or property's price based on one formula. So how does this actually apply in the marketplace? Well, cap rates tell us more than a rate of return. They're an indication on how much demand exists in a market. The important thing to note here is that there's an inverse relationship between cap rates and a property's value, meaning that when cap rates are low, prices are higher, and higher cap rates lead to lower values. To go back to the idea of a business, the market is valuing that asset based on the income it can produce, and the more demand there is for that asset, the more willing buyers are to bid up the price, which ultimately leads to a compressed cap rate. For example, a buyer looking at a property in an affluent up-and-coming neighborhood in Phoenix that has a ton of population and job growth and the opportunity to push rents to market will have a much lower going-in cap rate due to competition for that asset than, let's say, a property in a tertiary market of Oklahoma, hours from the nearest big city with no upside potential. The end buyer in this case believes in the stability and future prospects of the Phoenix property, and they're more willing to rely on appreciation, the business plan they can implement, as well as rent growth over the long term instead of the going-in cap rate today. Now that we have an understanding of cap rates, there's 3 things you're going to look out for as a passive investor in your next deal. The first is the going-in cap rate. This is the cap rate at which the sponsor is buying the asset. I do want to caveat that this going-in cap rate is much more relevant if you're investing in a stabilized deal where there's not much upside or value add potential and the plan is to just buy and hold. If that's the case, you can gauge if the cap rate seems high or low by asking the sponsor directly, or you can look at other offerings in the market for a similar type of property and also research recent sales that occurred in the market. The second application with cap rates is to look at the stabilized or pro forma cap rate. As mentioned before, in most multifamily investment opportunities, there will be some level of adding value, like renovating interiors in order to increase rents. This in turn will increase the net operating income at the property, resulting in a higher stabilized cap rate. And what you really want to see here is a good spread between the going-in cap rate and the stabilized cap rate, because that margin is representative of the value being created, which is where you make money as an investor. Last but not least is to ask the sponsor about the exit cap rate they plan to sell at when the deal ends. Recall from before when we said that lower cap rates result in higher valuations and vice versa. With this in mind, you want to see that the sponsor's underwriting assumption is that they're selling at a considerably higher cap rate than what the market might be at today. This would indicate that they're being conservative on the selling price years into the future and presuming the market conditions that they're selling back into aren't as strong. As a rule of thumb, for every year the deal is held, the sponsor should bake in about 20 to 25 basis points per year to land on the exit cap. Let's tie all of this together. An ideal outcome when investing in a multifamily opportunity is seeing a deal purchased at, let's say, a 4.5 cap. When the business plan is executed, the operator turns that 4.5 cap into a 7 through their value add business plan. So they increased it by 250 basis points, which is a healthy margin. A few years later, after their business plan is executed and the property is stabilized, we'll assume the market's healthy and they can turn around and sell it for a 5% cap rate. In the most simple form, all that happened in this scenario is we purchased a stream of income, then grew that income, and when it was time to sell, the market valued that income either to hold it long term for cash flow or even grow it further, and ultimately paid us a great price for it. So I hope this breakdown was helpful for you, and if you want a quick reference, there's an article at rule72equity.com under the Learn tab that dives into this topic as well. And as always, if you're interested in diversifying your money out of Wall Street and into real income producing assets such as real estate, don't be shy to reach out. Talk to you soon.